2, 3 intro చదువు.
Good morning, friend. Darkness falls on the Dour US jobs market. A deep dive. The US jobs market is facing significant challenges, highlighted by the recent ADP private payrolls report showing a loss of 32,000 jobs in September, far below expectations of 51,000 gain. August features were also revised downward from a gain to a loss of 3,000 jobs, indicating a contraction not seen since the 2008 financial crisis. This downturn coincides with a US government shutdown triggered by congressional deadlock, halting official data releases, including the crucial September non-farm payrolls report scheduled for October 3rd. The shutdown means the Labor Department is going dark, depriving markets of key indicators like jobless claims and payroll data, leading to heightened uncertainty. Private sector hiring has stalled, with small businesses driving the September decline, and losses widespread across industries like professional services and LDI-SURE. Healthcare remains the only consistent source of job growth, but even that has slowed, adding just modest numbers amid border weakness. The ADP data, while not always aligning with official figures, underscores a fading monument in the labor market that began earlier in 2025. Unemployment has ticked up to around 4.3%, the highest since 2021. Reflecting difficulties for job seekers in a cooling environment. Border measures like the JOLTS report show job openings at 5-year lows, with hiring rates matching post-2013 loss. This slowdown is exacerbated by high interest rates limiting business expansion in investment. As the Federal Reserve has held steady despite earlier cuts. Corporate layoffs have surged, with nearly 900,000 announced year to date, the worst place since 2008, amid economic uncertainty. PROXIES like ADP. Policymakers, including the Fed, are now flying blind, complicating decisions on inflation and growth. Recent revisions suggest labor weakness started in early 2024 with benchmark adjustments revealing overestimation of prior gains. Sectors like manufacturing and tech face tariff uncertainties and AI-driven cuts contributing to the Dour outlook. Long-term unemployment claims are rising, nearly double early 2023 levels, signaling prolonged job search struggles. The shutdown's ripple effects, including delayed CPI and another starts distorting economic assessments. Investors are pricing in quarter point cuts at upcoming Fed meetings, with some odds for larger moves. Despite reliance in some areas is private sector, the economy's engine is sputtering. Rising RECESSION fears wage growth has stabilized but lacks inflation in some segments, eroding worker purchasing power. The trade of fewer job postings in teach and marketing reflects reducing demand for knowledge workers. As data voids persist, markets may lean on high frequency indicators, increasing noise over signal. Federal employee layoffs highlight INEFFICIENCIES with public sector pay outpacing private despite lower productivity. Border economic policies like potential tariffs loom as PRECURSORs to further impacts. The confluence of shutdown, weak ADP, and revision paints action? Should investors brace for increasing market volatility without official reports? Is ADP revision of August jobs a warning of overstated prior growth? Are small businesses are canary in the coal mine for hiring trades? Should the Fed prioritize rate cuts amid this data void? Is healthcare jobs growth in INSUFFICIENT to offset another sector declines? Are rising long-term unemployment claims a red flag for recovery? Should traders really more on private proxies like ADP now? Is gold surge justified by safe haven demand from job woes? Are federal furloughs adding unnecessary strain to consumer spending? Should policymakers resolve the shutdown to restore data flow? Is the 4.3% unemployment rate masking deeper labor issues? Are tariff uncertainties contributing manufacturing job losses? Should wage stabilization else concerns despite inflation lags? Is the private sector's stall treating overall GDP growth? Are benchmark revisions revealing hidden weakness from 2024? Should marketers interpret weak ADP as good news for cuts? AI is driving layoffs. ACCERLE the downturn? Are JOLTS loss indicating persistent hiring CAUTION? Should job seekers diversify into RESILIENT sectors like healthcare? Is the lack of jobless claims data heightening speculation? Are global markets at risk from US labor occupancy? working age beyond traditional employment figures. As of the latest release on September 3rd, 2025, covering August 2025 data, job openings held steady at 7.227 million with rate of 4.3% of total non-firm employment, uncharged from July's 7.2 million openings. This marks are stabilized after declines earlier in the year, but the level remains near multi-year lows, down significantly from past pandemic peaks, exceeding 11 million in 2022. Highest totaled around 5.1 million with rate of 3.2%, showing little change month over month and remaining subdued compared to historical norms. The hiring rates persistence at lows since mid 2024 signals CAUTIO US employer behavior amid economic uncertainty. The Quiets rate dipped to 1.9% in August, the lowest of 2025 so far, with 3.1 million quiets, indicating reduced worker confidence in finding better opportunities. A stark contrast to a great resignation era when rates topped 4% in 2021 to 2022. This downtrend is quite below pre-COVID average, about 2.3%. Ages wage pressure PRESS are suggested a cooling in labor market tightness. Layoffs and discharges held at a low 1.1% rate, contributing to total separations of 3.2%. 5.1 million, reflecting minimal involuntary turnover in overall low churn in the economy. This stability in low layoffs underscores resilience against RECESSIONARY Economically, from 2020 to 2025, JOLTS trends reveal a volatile arc. Openings exploded during COVID recovery in 2021, surpassing hires and fueling inflation via tight supply, before steadily contracting as the Federal Reserve hiked rates to curb overheating. By mid-2025, openings have fallen to levels not seen since late 2021, with the unemployment to openings ratio reaching 1.0 in July, meaning available workers now match vacancies. To shift from the workers' storage imbalance of previous years. Quits rates followed a similar boom and the burst pattern, peaking amid high demand but trending downward since 2023 as economic headwinds like higher interest rates, dampening job switching. This sustained decline to 2025 points to a normalization toward pre-pandemic levels, with implications for moderate wage growth and reduced INFLA, TIO and ARY risks. Border trends show sector-specific variations. Cooling is pronounced in professional services and tech, when healthcare maintains steadier openings. Overall, the low churn environment, low hires, quits and layoffs indicates a labor market in pause mode, balancing growth without overheating. This pattern supports narratives of soft landing. This policymakers like Fed viewing the subdued data is justification for potential rate adjustments through persistent weakness could signal risks if openings continue drifting lower in weekly at October 28 to 29. December 9 to 8 meetings. With one more 2026. Through decisions remain data dependent. Market expectations align closely, precising in a 98% chance of another 25 basis point cut at upcoming October meeting, flared by weak jobs data and the government shutdown, delaying official September payrolls. Border forecasting suggests rates could fall to around 3.5% to 4% by year end, balancing support for growth against inflation risks from factors like potential tariffs. New York Fed President John Williams emphasized that the September cut aimed to boost employment without easing too aggressively on information. Potentially pressures, including from the Trump administrations, have influenced perceptions but not overridden the Fed's independence of focusing on dual mandate goals. Upcoming data voids have the shutdown may amplify volatility, but the Fed is flying blind, yet committed to assessing labor inflation, the global developments. Overall, the TRAJECT points to gradual easing to navigate a cooling jobs market while monitoring